Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Hi, everyone. Welcome to your Top 5 at 5. So pleased to continue to bring this great content to you. Today we've got Barry Schwartz. He's the Vice President and Chief Investment Officer at Baskin Wealth Management. Barry, great to have you on in this format. Thanks so much for joining us.
Catherine, it's wonderful to see you.
Thank you. We got a lot to get through in 20 minutes. That's kind of the goal here. And your top 5 stocks, given the market, it's down today. And really the focus name in the market is Facebook.
Yes.
Meta. And one of your top stocks you're going to talk to us about today is in fact Facebook. So let's talk. What in the world went on? Why is the stock down 20%? Why do you still like it?
Yeah, I think it's down 25%. So that's so shocking to see one of the world's biggest companies down so much. This is a shoot first and ask questions later type of market. I'm not sure why the market is so grumpy, or the algorithms are so crazy on some of these stocks. We saw Netflix down a lot after it missed earnings with PayPal. We'll have Amazon earnings soon. I mean, God forbid it misses. So the bottom line for us with Facebook is, if you've owned Facebook for a long time, which we have and our clients have, drops like this, unfortunately, are nothing new. In 2018, Facebook missed its earnings expectations. The stock dropped, I think, 20% the next day. And I remember the headlines were the exact same thing that's happening now. Oh no, how are they going to grow? So much competition, so much regulatory stuff. Everybody hates them. Delete Facebook, get out of it. I get those points. And my retort back to investors is, well, now the stock is incredibly cheap. You're not giving it any credit for the fact that it has 1.9 billion active users, people checking it multiple times a day. And this company has to continually reinvent itself. So it's facing challenges from TikTok, from Netflix, from YouTube, from Apple and Google that seem to want to crowd out these social media stocks. And hey, no story is without its warts. I mean, I wish I could come on to your program and say, here's a stock and the straight line going forward for the stock price is going to be up and to the right. It doesn't work that way, but we think there's great opportunities going forward for Facebook.
Yeah, it was interesting because when I looked at the numbers, and there was there were misses in terms of some of the active users, et cetera. Engagement was down, but the misses weren't huge.
No. It's all about the guidance, Catherine, right? So no one cares about what you did on December 31st. It's about what you think is going to happen over the next 3 or 6 months. Facebook is lapping some really tough comparables from the prior year. This is a really, I hate to use the word endemic, but because we're in a pandemic, but this is the result of what has happened for a lot of companies. They just had enormous growth in 2020 and 2021, and that can't continue. Facebook, prior to COVID, its growth was slowing. Then, of course, we had the COVID boom. Everybody was stuck at home, online shopping, checking their phones. What else is there to do? Now, as the pandemic recedes and becomes hopefully endemic, people can go out and do things and less reliant on some of these stay-at-home type platforms. It doesn't mean they're going bankrupt. It doesn't mean that their results are going to be terrible. But the expectations for the street, for investors, obviously was way too high.
And so just in terms of looking at the valuation, I don't know if you have the metrics in front of you, but what is attractive about it on a valuation perspective right now? And then also when you think about Facebook and you think about the growth, what is the growth? And I'm not saying they have to like hit it out of the park, but like what is the fundamentals that keeps us excited about the company?
For sure. So we have 1.9 billion active users, and what they're trying to do with those 1.9 billion active users is to get them to spend money and stay on the platforms, right? And so it's still the best place for local advertisers, small businesses, large businesses to get curated a list of people who are actively paying attention. So they need to monetize those users, and what they call it is average revenue per user. And if you look at those charts that's posted on Meta's investor relations site, those numbers are increasing. So the number of users isn't going to increase, but hopefully the average revenue that they can generate from active users will continue to grow over time. How do they do that? By charging advertisers more money to access those users. The problem is right now with Apple and the changing of some targeting advertising is that Facebook isn't able to provide as good data to advertisers. It's hoping that they will figure out a workaround. They're working hard on it. And we're hopeful that over time, that average revenue that it generates from users will continue to go up. In the same time, they're hoping to add more services, more products, get people to do more things. That's why they're launching this metaverse. And so if you have those active users, you launch more services, you get more revenue, that will be a good story. Is the growth going to be 40% of a year anymore? No, it's going to slow down to 10 or 15%. You know what? That's still very attractive for a stock that probably is going to earn around $14 a share in 2022. The stock's trading at, I see $245 today. But it's also perfect balance sheet, generating an enormous amount of free cash flow and investing for the future. So you put that all together, I think the stock's trading around 15 or 16 times earnings for a company that's probably going to grow revenue 10 or 15% a year for a number of years. This is an attractive, but right now the market just hates selling. I hate it. I want it out of my portfolio. I can't believe I own it. Sell.
Yeah, absolutely. Okay, we've done Facebook. Let's move on to Netflix.
Yeah, so this is another one that took a real big stumble the last few days after reporting its earnings, and then all of a sudden shot up because Bill Ackman of Pershing Square noted that he bought a significant stake in the company, and he's on fire, Bill, in terms of his few stock picks over the last little while. He's redeemed himself from the Valiant disaster.
Oh yeah. So, what's the interest though in Netflix these days? You know, and there is a lot of competition.
Oh, for sure. But I think Netflix is kind of like the utility. It's the one you're always going to go to first, and then maybe check, what's on Disney, what's on Amazon Prime. Well, there's nothing on Disney. I'm going to get rid of Disney, but keep Netflix, right? It has the most content, the most original new content coming on every month. They're the biggest, so they get the economies of scale and really a nice flywheel as they get more subscribers, to buy more content, to reward those subscribers. The growth is slowing there too. I mean, these companies can't continue to grow at such huge rates anymore. But on the other hand, you're not paying a very high multiple for the earnings. And most importantly, we think Netflix is now going to be free cash flow positive, right? It now has so many subscribers, its content spend growth is slowing. So what's remaining after that is just excess cash. And it says it's going to use that excess cash to start buying back stock or make acquisitions. So we're pretty excited about what's going to happen over the next few years.
And Barry, when we think about Netflix and how it originally started, right, with the red box, renting videos at the grocery store.
Yeah.
Right? Now this is a completely different company. What do we think about, or I don't know if we know, are the companies, talking about this on any kind of conference call, but what do we think might be their next area? I mean, obviously they're doing this, but do we know anything else that they're looking at?
So the goal for Netflix and all these platforms, whether it's Facebook or Google or Apple, is engagement. It's to continue to keep you interested, keep you paying attention. adding more customers, and then hopefully getting you to spend more money on more services going forward. Netflix has been pretty adamant that it's not going to launch ads, that it's not going to charge you for video games, which is an area that it's interested in getting into. But once you have a platform like this with so many customers, over time, hopefully Netflix will continue to raise prices. So when Netflix first started, it had much lower prices than it does today, as well as different tiers. Now they've allowed with a higher bandwidth, you can get better quality video, you can add more people watching it in your house. So, but really the growth for Netflix is outside North America. There's just so much potential in other countries. And I think they've really scratched the surface in some countries. I mean, they can't get into China, but as the broadband improves around the world, the thesis is Netflix will get more customers, have localized content, and be able to slowly increase prices over time.
Okay. Let's take a look at another one. Charter Communications. And by the way, everybody, these are all U.S. companies we're going to be talking about today. Charter, CHTR is the ticker there.
Yeah. So when I think about the types of things in my life that I can't live without, I think, aside from my wife and my family and my job, is the internet. So I have two young boys, 17 and 14. When the internet goes out in the house, there's hell to pay, right? Screaming, yelling, oh my God, there's nothing to do. Fix it. Can't you fix? It's a disaster. And so Charter is a play on providing cable and broadband service in the U.S. It has access to about 50 plus million homes in the U.S. There's 140 million plus homes in the U.S. So still long runway of growth for it to acquire new customers. And it targets, similar to the U.S. Canadian guys, it targets residential homes and businesses, and slowly offering more bundles, including mobile plans as well. But its bread and butter is broadband, internet connection, and cable connection. And its bread and butter as well as having very low prices and fast internet connections. And so
who would be their competitors then?
Comcast or AT&T, Verizon. So even though the U.S. is almost 10 times bigger than Canada, there are fewer competitors than we have in terms of mobile and I guess cable.
Why Charter though versus a Comcast? What is it about them?
Excellent question. So Comcast is a much more diversified company. It has its theme park business, Universal Studios. It owns actual networks like NBC and Peacock. And it's been, in our opinion, a lousy allocator of capital. It is trying to get growth. I think at one point Comcast tried to buy Walt Disney. It's bid for assets outside North America, where Charter says, we're just a pure play cable company, and we're going to use all excess free cash flow to buy back stock. And it's been a brilliant capital allocation story for investors. The Canadian investors are familiar, obviously, with Rogers and Bell and TELUS. Those companies are really focused on paying dividends with the excess capital, whereas Charter just buys back stock. And if you look at the stock chart, it's clearly working for Charter. It's not a fast-growing business, maybe 5 to 7% revenue growth, but it's a levered play on buybacks, and they've done a great job.
And what's the valuation like? And do you ever see them paying a dividend?
I don't think so. This is a John Malone story. John Malone is a famous cable investor in the U.S., owned Liberty, sold the company TCI Communications to AT&T. He's a billionaire, and he has a major interest in Charter Communications along with a number of other companies. His story, his claim to fame is using leverage to buy back stock and hopefully one day trying to sell it. I mean, there are some people that think the end game for Charter is a sale of the company to Verizon or at AT&T. Who knows? It seems unlikely with AT&T's balance sheet right now. But do we ever see them paying a dividend? No, that's not in the playbook. As for the valuation, Catherine, it is very attractive. It at one point in the last few weeks, given the market pullback, it was trading around 8 or 9 times enterprise value to EBITDA, which is more of a metric that people use for cable companies. It was actually trading at a discount to the Canadian companies, which makes no sense because Charter does not have as much communication, as much competition and regulation, and much faster growth. For example, Rogers and Bell are only growing at 1 or 2% a year. So Charter is a better story in our opinion.
And sorry, what's the growth rate on Charter, do you think?
It's about 5 to 7% a year in terms of revenue growth.
Nice. Yeah, I mean, I told you this before we started, but I did buy Charter when it was $2 to $3 right out of bankruptcy, and I got so frustrated I sold it. So
this is a great lesson for all investors. Yeah.
You're convincing me. I'm not convincing, but I'm going to take another look at it even now. Okay, and I'm keeping us honest to time, like I said I would to everybody. So now this other company, I don't know it. Watsco. Watsco,
ticker WSO in New York. So this company came to mind for me over Christmas when my furnace went out. So you can't live very long in Toronto without a furnace, especially during COVID when no one wants you in their house. So Watsco is the leading distributor of HVAC parts in US and Canada. And yeah, so it's a provider of things that you cannot live without. And its claim to fame, its track record is really making smart acquisitions over time. It's a roll-up story. It started as a small distributor and has built up its distribution network all across the US. It has a market share of about 15%, so still very small. And as it gets bigger, it's able to provide contractors. So that's who it sells to, the contractors that come and actually do the work on your furnace or air conditioning. The parts, it has the most inventory, the best ordering system, salespeople on staff to help if there's any issues. So, if you're a small contractor, a small HVAC repair company, you want to get reliable service, you want to get reliable parts and good pricing, you're probably going to go to the biggest guy on the street, which is Watsco. Unlike a Charter, which we just talked about, which is focusing on buying back stock, Watsco is focusing on dividends. It has a terrific track record of increasing its dividend over time. And the management has a very interesting compensation scheme. They're not allowed to sell stock until they retire. So they must buy shares, hold those shares, and can't sell them. So if they can't sell them, they're going to want dividends.
Interesting. Well, I'm going to take a look at that one as well. Okay.
Yeah. And
valuations obviously somewhat attractive.
It's not cheap, but it's probably trading at around 25 to 30 times earnings for 2022. It has a 2.5% dividend yield. But I think this is one where you can't, this is Amazon proof. You can't install an air conditioner by yourself. You can't install HVAC by yourself. So, and it has such great relationships with those contractors as well as the original equipment manufacturers that I think it's really established itself for long-term growth going forward.
Okay, great. And then the last one that you bring us today is Visa.
Yeah. Which its stock really hasn't gone anywhere over the past couple of years, although I think in the last month or so kind of picked up a little bit as people are recognizing that Visa has an incredible business inside Visa, which is cross-border payment processing, right? So when you go on vacation outside Canada or you're in the US and you go to Europe and you use your Visa card, it's essentially free money for Visa. The margins on processing transactions, if you stay in a hotel overseas or you use your Visa card for a restaurant, is just 100% margins. And of course, during COVID, when no one was traveling or canceling their trips, that business was pretty lousy. But it's picked up over Christmas time, and hopefully as COVID recedes and the summer travel season picks up, Visa is going to generate enormous returns from that part of its business. In the meantime, no one's using cash anywhere. People are online shopping. There's lots of competition. There's PayPal, there's Stripe, there's Adyen, there's you name it, but they all run on the Visa rails. So I don't care which one people own, Visa or MasterCard. I just think these are just wonderful businesses that have fallen to attractive levels.
And is there anything from PayPal's quarter that we should think about as it relates to Visa? And it was down if anybody's not watching that one.
Yeah, no, that was a nasty move on PayPal. So Visa actually reported a few weeks before PayPal similar quarters, and it was a stark difference. Visa said things are going great. We expect a strong year, whereas PayPal lowered its guidance and expected a rough year. PayPal has many fewer transactions and really more people to people than people to businesses. So that's the difference between PayPal and Visa. I'm very attracted to PayPal. I think the valuation is crazy low here, 400 plus million users, and the people who use it love it a lot. Canadians don't really use PayPal a lot. We email transfer money to each other, but in US it's a dominant platform.
And with Visa, what's the dividend? Do we care? It doesn't. It's not the story.
If you look at the long term, it is a good dividend growth story. I think it raised the dividend in December 17%. So, I mean, a dividend increase is a nice tell by management that they're confident about the upcoming year. It's also a share buyback story, right? So I think it announced a $12 billion share buyback on a $400+ billion market cap company. That's pretty reasonable.
And what's the valuation like?
Yeah, so we expect Visa to earn about $7+ in 2022. So it's trading around, I mean, it doesn't sound cheap at 30 times 2022 earnings, but this is a company that is probably one of the greatest franchises the world has ever seen. And comparable businesses can trade up to 35 to 40 times earnings. And we expect better days ahead, of course, as travel starts to pick up and people start leaving their houses and spending money on doing things.
Yeah, and I think American Express highlighted that in their quarter as well, that they're actually seeing a nice pickup to almost, I think pre-pandemic levels are certainly significant.
Yeah, well, American Express is even more levered to travel, as you know, and certainly on the higher end, whereas Visa processes transactions for, people of all income levels. American Express is the much higher spend. And that, if you really are excited about travel, that would probably be the better way to play it.